Hello traders, welcome back to my channel. In today's video, we are going to break down one of the most fundamental concepts in forex trading, which is currency pairs, including the base and the code currency. Understanding this will help you navigate the forex market with confidence and set a strong foundation for your trading journey. So let's dive in. Now, what is forex currency pair? In the forex market, currencies are always traded in pairs, that is in twos. That means when you are trading, you are buying one currency while selling another at the same time. These pairs consist of two currencies known as the base currency and the code currency. For example, when you see Euro USD, it is a currency pair where the Euro is the base currency and the US dollar is the code currency. It basically means how many units of the code currency, which is USD, are needed to buy 1 unit of the base currency. And mind you that the base currency must be higher in price than the code currency. So take for instance now, Nigerian Naira and the United States dollar. So since United States dollar is higher in price than Nigerian Naira, United States dollar is great, it should be the base currency, while the Nigerian Naira is the code currency. Now let's talk about two segments of currency pairs. Number one is the base currency. The base currency is the first currency in a currency pair. It is what you are buying or selling when you place a forex trade. For example, in Euro USD pair, the Euro is the base currency. So if you are buying this pair, you are essentially buying euros and selling US dollar at the same time. Let's make it simple. Think of the base currency as the anchor of the trade. It is the reference point against which the value of the second currency, the code currency, is measured. Now, number two, the code currency. The code currency is the second currency in the pair, also called the counter currency. It shows you how much of that currency you need to buy 1 unit of the base currency. For example, in Euro USD, the US dollar is the code currency. If the price of Euro USD is 1.2000, it means you need 1.200 USD to buy 1 euro. Take for instance again, if the price of USD against Nigerian Naira is 1,600, that means you will need 1,600 Naira to buy 1 USD. So that's it. If you are selling the pair, you are selling the base currency and receiving the code currency in return. Now let's briefly discuss the three categories of currency pair that you will come across when trading forex. Number one is major pairs. These are the most traded pairs in the world, and they always include the US dollar as either the base or the code currency. Example of these major pairs are Euro USD, GBP USD, USD JPY. Major pairs are known for their liquidity and typically have low spreads. Check out the video where I explained about spread to understand what spread is all about. Now, the second category of pair is minor pairs. These pairs don't include the US dollar but are still widely traded, like Euro GBP, that is Euro Great Britain pounds, AUD NZD, that is Australian dollar New Zealand dollar, or Euro JPY, that is Euro and Japanese yen. The liquidity here is a bit lower than the major pairs, and the spread can be wider compared to major pairs. Now, in the third category, the last one, is the exotic pairs. Exotic pairs consist of a major currency pair with a less traded or emerging market currency like USD ZAR, that is United States dollar against the South African rand, or Euro TRY, that is Euro against the Turkish lira. These pairs tend to be much more volatile and can have high spreads. Now, understanding the dynamics of currency pairs is a vital step in mastering forex trading. Once you grasp the concept of base and code currencies, you can start analyzing pairs more effectively and make informed trading decisions. So that's a wrap up for today's video. If you enjoyed this video and found it helpful, don't forget to hit that subscribe button and turn on the notification bell so you don't miss future videos. Thanks for watching.